Hello, everyone. My name is William Mucker. I am a client executive with CamaPlan, and I would like to thank you all for joining us for today's webinar, Unlocking a Transformational Capital Gains Tax-Deferred Exit Plan for High Net Worth Individuals with Brett Swarts, founder of Capital Gains Tax Solutions. As a quick note, please be aware that Brett will be answering questions at the end of the presentation. However, feel free to use the Q&A function on your screen, not the chat, to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, I do have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. CamaPlan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of that dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at CamaPlan, nor do we endorse any products. We will never call you, about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into the investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information today have any questions about what is discussed in the presentation and how it applies to self-direction, please do not hesitate to contact me. I would be more than happy to help. Without further ado, I'll pass it over to you.
Thanks, William. Appreciate it. And I'm going to start us off with a little video here, just to give you a chance to. I need to screen share too, William. Is that okay?
Absolutely, go for it.
Okay, I think you have to stop screen sharing yours, I think. Oh, here we go. All right, I think we're good now. Okay.
Are you telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye-opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like-kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
All right, everybody. Thank you so much for being a part of this and spending your time with us. My name is Brett Swarts. I'm founder of Capital Gains Tax Solutions. And, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. And at the core of our belief is that if you don't have a clear plan and if you don't have confidence in that plan, it's very difficult to achieve tax deferral in a way that creates a transformational way to invest your wealth or spend your time and your energy. And so we focus like a laser on something called a Deferred Sales Trust, and equip people with this every single year to give you not only capital gains tax deferral, but liquidity, diversification. And my favorite of all of these is called optimal timing, where you can invest into properties or businesses or other assets when it makes sense for you based upon your cash flow and your tax flow strategy. And so in this presentation, we're going to unlock how to really help you get from A to B. A is currently where you're at right now, and B is perhaps where you want to go with your wealth. But perhaps you've struggled or have had challenges when it comes to the 1031 exchange. You've struggled or have challenges for certain assets that don't qualify for a 1031 exchange. And you're looking for something that's going to give you true to diversification, liquidity, and again, the ability to go back into real estate when it makes sense, if it makes sense, or other asset types. And there's three things that a lot of our clients are facing right now before they meet us, or potential people that are meeting us for the first time. And they're centered around some confusion of what their options actually are, isolation in that maybe they don't have a team of professionals to help them execute what they're trying to do, and powerlessness, just saying like, I feel frustrated because the market is changing rapidly and there's a lot of headwinds that we're facing right now. And my goal is to help you give you clarity today, to give you some connection with our team and what we're doing with this strategy, as well give you some creativity, ways to unlock again what you might be trying to accomplish. And so I would encourage you to really clarify where you're trying to go. If A is where you're at right now and B is where you're trying to go, you want to clarify what that looks like. What is that outcome for you and for your family and for your wealth? And currently where you're at right now, and where are you feeling trapped or a little bit stuck, right? Where you're a little bit confused, feel a little bit isolated, or feel a little bit powerlessness when it comes to unlocking that wealth or selling that asset and having this capital gains tax. Because what we're facing, it's a very large tax for our clients and for those who might be listening today. And that's somewhere between 25 and 50% of your gain is going to be wiped out by capital gains tax and depreciation recapture, unless you have a strategy to defer that or mitigate some of those taxes. And so there's 5 freedoms, by the way, that I'm going to weave through this entire presentation. And these, I believe, are the 5 freedoms, at least 5 freedoms that you'll need or want to unlock what's called transformation. Some of these have to do with time, just how much time and energy are you spending on your properties or your business or your investing, right? Some of them have to do with location. Do those assets or those businesses or where you're living, like a primary home or a business, geographically kind of restrict you from moving on and having those kind of freedoms? Is it financial freedom? Perhaps you're real estate rich, but a little bit cash flow poor, and you're looking for truly to be financially free by unlocking this capital and making it go to work for you to create more cash flow to offset your expenses even more. Is it 1031 freedom? You're just tired of being in this 1031 exchange. I call it the shotgun wedding, right? Having to get engaged in 45 days, married in 180 days. Is it entrepreneurial freedom? Are you looking to start a new venture? Are you looking to unlock stock or crypto or a business or a primary home and use the capital tax deferred to launch your next business venture or launch your next real estate development project? So, or the last one is estate tax freedom. Are you ultra high net worth and you're looking at a 40% death tax and you're looking for an elegant way to eliminate that estate tax? And so these are, in fact, I mentioned 6 freedoms. I gave you a bonus one there as well. These are the 6 freedoms I believe you can unlock 1, 2, or 3, especially if you can unlock all 6. It leads to transformational exit planning, where most exit planning has to do with maybe 1 or 2 of these. It rarely does it have the opportunity to do all of them or more than what you're looking for. So with that being said, please also, as we go along, feel free to type in the chat your first name and any questions that you have. I promise I will get to those questions as well. We want you to not lose those thoughts as you're having them. So make sure you type in those questions along the way. And And then we also have an opportunity to do questions and answers at the end. I might answer them right away, but I also might know that it's coming up in the presentation, and therefore I might just continue on here. So, and answer them later. Okay. So again, this is called Unlocking a Capital Gains Tax Exit Plan. And part of also what I want you to teach you right now is how to eliminate the need for the 1031 exchange, and the goal so you can create and preserve more wealth. And so as a little bit of a background, I am Brett Swarts, and I'm founder of Capital Gains Tax Solutions. I'm a deferred sales trust expert and also a deferred sales trust trustee. Every transaction takes a third-party trustee, and that's my role at Capital Gains Tax Solutions. As well, I'm a commercial real estate investor, and I grew up in the real estate business. I love cash flow producing real estate. I'm also a multifamily broker. I help clients still buy and sell multifamily properties here in Sacramento with my team. But we're a national company, Capital Gains Tax Solutions, and we do deals in all of the US. And so also my legal disclaimer as well, this message is for educational purposes only and solely intended to provide an overview of how the Deferred Sales Trust works and how it can be implemented. But Capital Gains Tax Solutions does not provide legal, tax, or professional service or advice, although we do have our business partners that are the tax attorneys that do that. And that's a part of the no cost engagement that we work with groups like, or individuals like yourself. We also encourage you, though, to bring in your own independent legal advice to make sure that you're getting all of your answers to all of your questions, that you're not missing anything there. Okay, so so again, our agenda real fast is to learn how to escape feeling trapped by capital gains tax using a deferred sales trust, to unlock a transformational exit plan, and also maybe to unlock sleeping capital to increase your cash flow and your tax flow. Okay, so here's the premise. Are you reluctant to sell because of capital gains tax? And, you know, our clients, by the way, our minimum deal is 1 million net proceeds, $1 million gain. So it's got to be a big enough gain to qualify for the deferred sales trust. So are you a millionaire or have an asset that's worth $1 million at least or more and has $1 million gain? And are you reluctant to sell because of the capital gains tax? You know, I believe this is the major reason most of our clients, before they meet us, they don't sell. Right? Because of this capital gains tax. And it's somewhere between 30 and 50% of their gain. And that includes state, federal, Obamacare, and includes depreciation recapture. It might be, you know, you might be able to get to like 25%, maybe if you don't have a lot of depreciation, but that's typically the minimum that we see. And so every single day, high net worth investment real estate, primary home, business, cryptocurrency, stock, owners, public or private stock, they pay hundreds of thousands to millions of dollars in capital gains tax when they don't have to. So who is the deferred sales trust for? Well, it's for anyone that has any of these assets, okay? And also if these assets have at least $1 million net proceeds and $1 million gain. And this is investment real estate. This is a business sale. This is funds that are at a qualified intermediary. Even if it's past your 45 days, we can save a failing 1031 exchange without having to identify it, by the way. It could also be GP or LP interest. It could be cryptocurrency, NFTs, primary home, private stock, public stock, carried interest, captive insurance, artwork. And I'll start with our first deal story. We actually just did a primary home, and this had to do with the transformation of location freedom and financial freedom and 1031 exchange freedom. He owned a home in Palo Alto, and this home was worth over $8 million right on University Avenue. And he had 6 kids, and all the kids were gone now, out of the house, all older. And so he's living in this big house that has huge appreciation. He's going, oh my gosh, Brett, if I sell, A, it doesn't qualify for a 1031, but B, I'm going to hit with huge tax, right? Huge tax. And so I don't want to be hammered with tax. And I also want to unlock financial freedom because this house has my majority of my wealth. I'll also mention maybe a 7th freedom, which is debt freedom, and that you don't have to replace equal or greater debt as long as you don't have any debt over basis. And so he wanted to get debt freedom. He wanted to get financial freedom. He also wanted to move closer to his family in Nevada. So he wanted location freedom, right? So he wanted these freedoms, but he felt trapped by the capital gains tax. And he says, Brett, I'm not selling because after I sell, pay off my debt and pay the tax, I basically walk away with nothing. He goes, so if your solution can provide this, this means the world to me. And so, by the way, he's also one of the top real estate professionals in all of Palo Alto for over 30 years. He would sell about $100 million for clients over the years. And say, Brett, this is something where, you know, clients could benefit from. So I want to use it for myself, but if this works, I want to use it for all of my other clients. And so he's very well respected, had a CPA do basically about 1.5 years of due diligence on the structure, on the strategy, a very sophisticated, smart CPA out of Palo Alto area. And so that being said, he used the deferred sales trust to exit his highly appreciated primary home, defer his capital gains tax, relocate to Nevada, and receive some financial freedom, some location freedom, some debt freedom. And it's transformational for him and his family because of this tool of the deferred sales trust. So that's just the first deal story. And we'll be weaving those in because I really believe that the practicality of this is so important to understand what's possible based upon what closed deal stories have happened. Okay. So by the way, what is a deferred sales trust? Like what is this thing, right? You might have heard of a DST before, but I want to clarify that this DST is the other DST. In other words, the other one that you might have heard of is called a Delaware statutory trust, which is just a 1031 exchange, Delaware, right? It's just another part of the 1031. I call that blockbuster. 1031 exchanges are like a blockbuster exit strategy where we have a deferred sales trust is like Netflix. They're similar, but very distinctly different in a number of ways. A deferred sales trust, first of all, is not a 1031. IRC 1031 is an IRS tax code. This number. Deferred sales trust is IRC 453, which is a different number. It's also like IRC 401k, right? These are different tax codes that have different rules and different benefits and different outcomes for clients. So understand that IRC 453 is the foundation of the deferred sales trust, which is it's just an installment sale. In fact, if you know seller carryback, then you know the deferred sales trust as foundation because it's just an ability for a seller to sell and lend funds to a trust in exchange for a promissory note. So I'm going to say it again. You're going to sell, you're going to lend funds to a trust in exchange for a promissory note. Now, these promissory notes are typically 10-year terms, typically 8% interest, compounding depending on the risk tolerance of the individual. As well, every 10 years you can renew for 10 years and you can pass it to kids and keep it going for as long as you want. But it has some very distinct advantages. First of all, you can defer 25 to 50% in capital gains tax and depreciation recapture. Pretty awesome. You can also defer income tax, right? So you can delay the trust from paying you back right away and let it build up, and you can delay some income tax, which is pretty cool. For example, my client moved out of Palo Alto. He established residency in Nevada, and then he started taking payments in Nevada. So he was able to receive in the state in which he's in, the Nevada no state income tax. Pretty cool on the interest payments. It's also a backup or a rescue for a 1031. We often save failed 1031 exchanges all the time because people run out of time, they run out of deals, and interest rates are going through the roof. And so they're going, oh my gosh, like I'm about to pay this tax, and we come in and we save it. Now, also sometimes we do a partial 1031. We work with a 1031 qualified union to do a partial, and then the rest of the boot can go into the deferred sales trust. So it can be a combination of strategies to execute. You can also get a new depreciation schedule. That's more of a tax flow strategy for active GPs, which is amazing because one of the number one reasons to own real estate is for the depreciation to offset the cash flow. We call this tax flow planning. It's not just about cash flow, it's about tax flow. And this allows you to get a new depreciation schedule, which leads me into the Monday morning quarterback, which has to do with optimal timing. And I don't know if anyone was a football fan, right? And they talk about the Monday morning quarterback. If the Monday morning quarterback knew defense was going to do before the play, he would throw, 15 touchdowns a game. I'm a big 49ers fan. I grew up with Jerry Rice, Joe Montana. That's my team. And we would always, analyze the games, afterwards, like, oh, if he would have saw that. Well, the deferred sales trust allows you to be that Monday morning quarterback. And here's why. You can sell high and you can buy low. And this is the single, if there's one thing you can get out of this presentation, it's what's called optimal timing. And this deal story happened, and this is the reason I started this company, Capital Gains Tax Solutions. This gentleman sold an asset, and this asset was about a $20 million asset in Minnesota. And in 2006, he's looking around for opportunities, and he's not seeing anything that makes any sense. And so he's not going to do a 1031, and he doesn't want to pay huge tax. So he goes out on a limb here, in the sense that he had never heard of the deferred sales trust before, close his equity into the trust in exchange for a promissory note. and he put it into conservative investments. And by the way, you can invest in the stocks, bonds, mutual funds. You can go into hard money lending. You can go into passive or active real estate. And so that's what he did. He just put it in conservative stuff, but he's not a stock market guy. He's a real estate guy. But he didn't want to pay the tax. So he put it in hedged and protected in instruments where it wasn't getting a huge return, but it was also protected in case the 2008 crash. And guess what happened? The 2008 crash. So he sold his property probably at the peak. And guess what happened? 5 years later, the person who had bought it was foreclosed on. And so they called this Deferred Sales Trust client and say, hey, do you want to buy back the property? He goes, well, maybe. What's the price? And they said 60 cents on the dollar. He said, that sounds like a pretty good deal. Give me a couple of days. And this is the Monday morning quarterback. He was able to sell high and buy it back from the bank, all tax deferred, not using a 1031 exchange. Now I'll say that again. He's able to sell high and buy it back from the using the trust money, all tax deferred at 60 cents on the dollar. And this is the part where like my brain or my strategy in my mind exploded. And I was at the time I was at Marcus and Millichap, and I was brand new in the business in 2006. I didn't learn about the trust in 2009, but I saw friends, family, and clients lose half or everything because of the 1031 exchange and overpaying for properties and not having diversification, having too much debt, not enough liquidity. In other words, not having a Netflix exit plan. They had a Blockbuster. And so I quickly said, oh my gosh, this will change everything. If this is true, this will change everything. And that began my journey of, well, if we can help people understand how to do this and why it's legal and how it's legit and how it all works, this will change the game forever. And so that's what he was able to do. That's the Monday morning quarterback. And I believe right now there's going to be some Monday morning quarterbacks. There are clients of mine who have sold high, have used the Deferred Sales Trust, and are going to be selling high right now, and are going to be waiting patiently on the sidelines to purchase at optimal timing and to create transformational wealth, which leads into the next thing, which is it solves 40% estate tax. Estate tax is anything to do with 24 million married, basically, or 12 million single. That's an exclusion amount that's not subject to capital gains tax. We can solve that and eliminate that. We've already talked about diversifying, liquidity, debt freedom, increase your cash flow, and you can retire as well. So, and then a little more about my background. I'm a former multifamily agent at Marcus & Millichap. I'm still a multifamily broker now with eXp Commercial as well. I have experiences in 1031 exchanges, Delaware Statutory Trust, and of course, Deferred Sales Trust. And at one point I held my Series 22 and 63 licenses for the Delawares. And we still help people with Delawares, but we just work with financial advisors to provide those. But at 2006, by the way, it wasn't always that way. I wasn't Leonardo DiCaprio just closing deals. This is kind of a quick backstory of me. I was the guy just trying to figure it out. I was one of the guys in the back just scratching my head. I was still graduating from college. I was playing college basketball. I was in an internship. I was in training. I was just trying to launch my career. And I was just getting newly married within this basically 2006 to 2011 timeframe. And I was just trying to make it in the business. And I saw the market crash, and I went from making a little bit of money and being very successful in college sports and college athletic scholarships and all of these things, basketball and a couple degrees, to literally like making almost zero overnight. And I remember it because it's a 100% commission job. And my wife and I, a baby on the way, said, oh my gosh, what are we going to do here? I can go get a real job in the sense of more 9 to 5, more stable job. Or I could continue my dream of being like a real estate broker entrepreneur. And that began this struggle. And so I did what every good entrepreneur, I guess, does. It was maybe at some point you might get a side hustle. And this was me working at Cheesecake Factory, not actually me right here, but it was like me. I wear the same tie at Marcus & Millichap that I wear at Cheesecake Factory. I felt like Clark Kent. By day I'd make cold calls at Marcus & Millichap, help people with the banks, help them with their rents, help them with their deals. And by night I'd work at Cheesecake Factory and try to keep food on the table and keep the lights on. So I worked 70-hour weeks, and I did this for 2 years. And so it's kind of living almost like two work lives, by nights and weekends, and then by day at Marcus & Millichap. But I kept growing and learning, and my clients were going through a similar struggle. They were losing half or losing everything, and partly because of the 1031 exchange. So I was going through my financial struggle. They were going through theirs, and I was really scared. I was feeling frustrated. So were they with a lot of things. They were dealing with millions, and I was dealing with like just, let's say hundreds of dollars to try to keep things going. But this is when I learned about the Deferred Sales Trust. And this is where it became, I started to talk about it, learn about it, and started to implement it with my clients. And I saw my business started to grow. And fast forward, my wife and I, we have 5 kids. We live in Roseville, California. And we are also going to be spending some time out in Florida as well, half and half in St. Augustine area. We're moving out there, and we'll be a little like 51% or so in Florida, 49% California. But this is what we do now. And I just teach and coach people how to do this and how to work the Deferred Sales Trust as a business professional or as a high net worth individual. So I discovered the hard way. And how many of you want to learn the easy way? I'm going to check the questions Q&A right now, by the way. Let's see here. Leverage real estates are not good investments for, are not good. Yeah. So leverage, you're right. Leverage real estate, John, by the way, if you over leverage, right, and you're not leveraging wisely, you can get hurt. And this is where people are going to get hurt. And Warren Buffett says that those who have been, you'll see in a downturn, those who have been skinny dipping, right? When the tide comes back out, and those who have overpaid or over leveraged, that's when you can really lose it all, right? Or lose a lot. And so this is happening with these adjustable rate mortgages, or the people, got some short-term debt that was fixed, but it's going to adjust and is going to increase drastically. There's going to have to be workouts, or there's going to be foreclosures. So I would agree. And that's part of why the Deferred Sales Trust is great. That's a good comment. Thank you for that, John. But after 10 years, I discovered the hard way. And how many of you want to learn the easy way of how to do this? And by the way, if you've been struggling, this is probably why. We call it the perfect storm. You had real estate at all-time highs. Stock just from a few months ago was all-time highs. Crypto from a few months ago was all-time highs. But now we're seeing this complete shift of the marketplace, right? And we call this the second wave of the storm. The first part of the hurricane happened, and then when COVID hit, then there was all the money they threw at it, right? The trillions of dollars. And then the eye of the storm was kind of calm for a little while. And now the second part of the hurricane is happening right now. And it's already, it's hitting, and it's kind of scary, right? And this is the part where you want clarity, you want connection, and you want creativity to make sure you're maximizing and building a wealth plan that gets transformation. And these storms are the challenges that are ahead of people right now that are feeling confused. They're feeling, powerlessness with what to do. And they're feeling, a little isolated, right? Like, what do I do with my wealth or my asset that I'm selling? I have a client that I'm talking with right now, and he's got about $20 million in real estate and multi-family properties in Sacramento. And we're looking at listing and using the Deferred Sales Trust as the primary strategy. And then the interest rates jumped. And so we're assessing that. And one of the questions I asked him, is if you had X amount of dollars, $6 million, would you buy the asset that you own right now? Would you want that amount of concentration of your equity tied up in that single asset? Or would you like to diversify? Would you diversify? Would you wait? And asking yourself that question can help you to assess whether or not it's a good time to sell. And that's why I believe it's still a great time to sell. And in fact, if you're even thinking about selling right now, we believe right now is better, because in a year, 6 months, 2 years, this real estate ship, if it's like a Titanic, takes a little bit longer to turn than do stocks or crypto, of course. And we're seeing the shift happening. The other storm that's happening is the $32 trillion of baby boomers. You have the largest wealth transfer in the history of the planet happening right now. So in no time in history do we know of a bigger time where more wealth is transferred from one generation to the next. And this is happening over the next 20 years, from the baby boomers to the millennials. Okay, now 50% of all the net worth in America is tied to high-end primary homes, commercial real estate, and private equity, which is businesses. That's 50%. Now, these 50% of all the net worth is illiquid assets that are highly appreciated, maybe more appreciated than we know of in the history of the planet. And so these baby boomers are looking to exit, but feel trapped. And it's the biggest wealth transfer in the history of the planet. So where the question will be, will the wealth be taxed, or will it be deferred or mitigated on these exits? And that's when the Deferred Sales Trust comes in. By the way, there's also the political challenges, right? The election was yesterday, and there's a lot of challenges with the politics right now, no matter what side you're on. Part of it's because there's $30 trillion plus in debt, and they're looking to raise taxes. They're not, inflation is going, pretty high right now. And it's frustrating, to say the least. But that is why your tax flow plan, to me, is more important than your cash flow at this point. especially if you've already built your wealth. It's no longer just about your cash flow. It's more importantly about your tax flow. Now, in the beginning, when you're building wealth, creating wealth, it's about the cash flow. But once you've created that cash flow, now it's about the preservation and the tax flow of that. And so this is where it's so important to have a plan and a strategy that unlocks the cash flow and the tax flow for you. So that being said, let's keep moving on here. If you've been struggling, this is also probably why. It's not your fault. Your CPA doesn't know about the deferred sales trust, right? Or they've heard about it, or they get it confused with the Delaware Statutory Trust. And it's not so much that they don't know, they just don't know how to do it. They've never seen it implemented. In fact, most CPAs before they meet us have maybe heard of inclination of it, but they haven't actually had a client do it. And the ones that we teach and train them and they sign the NDAs and connect with us, then they're offering it to their clients and they join us. Again, thousands of closes have happened with the Deferred Sales Trust, 26-year plus track record, billions under management, over 20 no change audits, formal and random audits with the Deferred Sales Trust. It's still batting 1,000. Okay, never had a single change, but your CPA doesn't know that until you connect them with us and we go through it together. Also, as a reminder, 1031 does not work for primary homes. The Deferred Sales Trust does. It does not work for business sales. The Deferred Sales Trust does. It doesn't work for stock or artwork or cryptocurrency. The Deferred Sales Trust does. Okay. And of course, if you've tried the 1031 exchange, you've no doubt felt the pressure of the 45-day shotgun wedding to get engaged, 180 days to close. And we just think there's a better way. It's the Netflix Deferred Sales Trust way, not the old Blockbuster 1031 way. By the way, you might have heard of a Delaware Statutory Trust. I mentioned that in the beginning. That's a part of the 1031 Blockbuster, but I'll let you know that it's the inflexible passive way. And we've closed Delaware Statutory Trust, and they do have their place to solve mortgage over basis. And we use that.
It would appear that we lost Brett. I apologize for that. Give me one moment. We'll try to get Brett back in. We're working on getting Brett in. If you want to say something in chat or questions, I'll do my best to answer them in the meantime. I'm trying to get a hold of Brett now. Slight technical difficulties, I would imagine. I'm assuming he may have lost connection. So I've been working to get a hold of Brett. At the moment, he must still be going through technical difficulties. So I don't want to keep your time any longer waiting unless you guys. Oh, perfect timing. Hey, Brett.
Hey, so sorry. The internet, the Wi-Fi just completely crashed at my at the condo in Kona that I'm in here for the next here today. So I'm so sorry about that. But I can go on.
I'm sorry, you cut out at the end. Is everything okay now?
So my Wi-Fi broke down. So right now I'm going by my phone internet. You know, the just the cellular service. So I don't know if and when the Wi-Fi is coming back. But can you hear me okay?
Yeah, you sound great. Do you want to continue or do you want to want to reschedule or?
We're almost done. We're just wrapping it up here actually, right? So I'm just gonna talk while I go. I won't be able to share my slides, but I'm just gonna talk. So we were just talking about the Delaware Statutory Trust, right? And it has some inflexibility to it, whereas the Deferred Sales Trust has a lot of flexibility. Now, the Delaware does solve for mortgage over basis issues, and there's times we're going to use the Delaware to solve that. Okay, where there's some mortgage or some debt over basis. So to the extent you have debt over basis, we use a Delaware to replace that debt or a partial 1031 to do that. And that allows us to use the rest of it for the Deferred Sales Trust. So one of the downsides for the Deferred Sales Trust is cannot defer debt over basis. So we have a solution for that using a partial Delaware, okay? So I'm gonna share a few more examples right now as well for deal stories. And again, if you have questions or thoughts, feel free to put them in the chat. But we do have a deal story that I just closed for a client. He was two clients. They're out of Las Vegas. They sold a $48 million multifamily property, and there were two GPs and a lot of other LPs. And they were able to move their GP interest into the Deferred Sales Trust. This is a part of their fourth deal they've done with us. Over $100 million of multifamily properties that they sold. They moved just their portions into the Deferred Sales Trust. So they can form one trust and have multiple promissory notes, which is pretty cool. In fact, you can hear his entire story. You can go to Capital Gains Tax Solutions on YouTube, and you can hear his entire story. That's David's story. David Sloan's story. We also have Ron and his wife. They sold a property in Colorado for $4.2 million, and they were able to defer about 30% in capital gains tax. This was a highly appreciated like Airbnb apartment complex, but it was taking up a ton of their time and their energy. And they're like, well, we're making good money, but it's just like they wanted that time freedom, right? So for them, the transformation for the Deferred Sales Trust was they don't have to do another 1031 that takes up more of their time, but they can still stay liquid and diversified. They don't have to overpay for a 1031. So they have that 1031 freedom. They have that time and energy freedom. And those two are transformational for them. They're like, this is amazing. Like, where has this been? And they use it. You can hear Ron tell his entire story too. That's Ron Anderson. Go to Capital Gains Tax Solutions on YouTube. And we also have an estate tax one that we solved for. Looks like we might have a question there. What's the smallest deal that would make sense? Good question, Dennis. So the smallest deal we found is $1 million net proceeds, $1 million gain per transaction, unless you have two at 500 each. So let's say you had a property that's worth 500,000 and it has zero basis. And then you have another, you have a cryptocurrency at 500,000 and it has zero basis. Those two combined equal 1 million net proceeds, $1 million gain. So that works, right? Now I have done deals that are a little bit smaller, but it's typically in the context that the client has multiple millions of dollars in assets. And so, for example, we have a client out of Texas. They have about $10 million portfolio, and they were doing a $275,000 deal. And I said, well, on its by itself, it's too small. That was the only deal you had. But as a part of the overall strategy, we can do this smaller deal because you're going to get scale as he moves his other assets into the same trust. Okay, so those are the minimums. But we did a deal for a client out of Colorado. I mean, they're actually out of California, but they're sold property in Colorado, a $5 million property. This is a multifamily complex. Their challenge was they want transformation and the estate tax freedom. So they had their net worth was over 25 million married, but they're still young, and so they're going, well, this is going to grow likely to double or triple by the time we pass away. So we have a 40% death tax. Realize that the 1031 is like Blockbuster because it doesn't solve for estate tax. It solves for stepped up basis. It gives you cap gains if you swap until you drop. So we love the 1031 when it comes to swap until you drop and get a stepped up basis for your heirs, but it has nothing to do with the estate tax, right? So you want estate tax freedom that the Blockbuster 1031 doesn't provide by using the Netflix Deferred Sales Trust. So upon exit, we were able in one day, one deal, without buying life insurance, without having to give it all away to charity, without having to gift it to a bunch of kids, not having to give any of the exclusion amount, we move all of the equity in this scenario, $5 million outside of the taxable estate. Now it took a legitimate third-party buyer, legitimate seller, fair market value. So it's not something you can just like transfer over like into like a living trust. A living trust, remember, has to do with probate. This is a deferred sales trust, and you're able to, it's actually the DST 2.0, which is a separate one from DST 1.0, move it outside your taxable estate. Okay, so that was really cool for them. They eliminate 40% death tax. I'll say that again, 40% on that $5 million. It's eliminated, plus any of the $5 million increase. So if it goes to 10 or 15 or 20 over their lifetime, all of that's outside the taxable estate, which is exponential return for their wealth. We just did another property. It had to do with a partnership freedom. I guess you could do 8 freedoms. The other freedom would be partnership freedom. And at 1031, the whole entity typically has to move, which means what? All of us partners have to stay together, typically, okay? Where it's really complex. Whereas the deferred sales trust, we call it the seamless partnership separation. Each of the partners, they want to do their own deferred sales trust, they can. In this scenario, they had 4 partners. They bought land in San Diego, and they built, there used to be a taco stand. They built an entire car wash business. And their total basis was about $4 million. They sold it for about $13 million. So they're looking at about 40% cap gains tax and depreciation recapture. Well, out of the 4 partners, one of them just wanted to pay his tax and take his cash. So he was able to go his separate way. The other 3 did the deferred sales trust, and they deferred all the tax. And they're really excited because now they're in a position. They sold probably the best time. They sold it, I think it was right around January, before the market really started to shift. So they sold it optimal timing, and then they want to build more projects, and they're diversifying the wealth with an extra 40%. So that was a $13 million deal in San Diego. We also did a Bitcoin sale. She bought it for 50,000 Bitcoin, and then it went to 50 million. We were able to exit 5 million of that for our client. This is when Bitcoin was at 54,000 a coin, which is she got out before the Bitcoin crashed, basically like 15,000 a coin. So that was pretty cool. The next one would be, let's see here, an Ethereum client. He did 7.5 million of Ethereum exits with us prior to the crash of crypto. Also prior to some of these groups like Celsius that have lost all the money, or majority of it's gone, where people got hammered because they weren't diversified. So he was able to sell, and he was able to retire from his W-2 tech job, which is transformational for him and his family. He had a young family with kids, and so okay. So those are some of the deal stories. So I wish I could share my screen, but I can't. So I'm just going to walk through the steps about how you would go about doing this. If you're ready to move forward, like what are the steps, Brett? This all sounds amazing. Like what are the steps? Step number 1, you want to map out a wealth plan. If you have a financial advisor, let's bring them in. Okay. If you don't, we have financial advisors. Okay. We want to map out a wealth plan, and then we want to incorporate how the deferred sales trust can get you from A to B. A is where you're at right now. B is what you're trying to accomplish. And let's define like a laser how this strategy is going to help you accomplish what you're trying to accomplish. So that's step number 1, is just do some planning. And by the way, we do no cost planning. So we don't charge unless you close in the deferred sales trust. We will talk with your CPA, financial planners. We'll go through it all, and we'll no cost kind of tax flow analysis. Step number 2, though, if you're ready to move forward, is you're going to have a trust form. These trusts are single entity trusts. They only do business with you, and if you're married, your spouse. But you can transfer the assets to this newly formed trust prior to the close of escrow in exchange for a promissory note, right? So you're taking an ownership hat and you're becoming a lender. And then the DST sells the asset to the ultimate buyer, and everything, all the smoke clears, and you're left with a promissory note. So let's say you had a $5 million asset that had a 0 basis and no debt. Instead of selling this $5 million asset to a buyer for $5 million and just paying all the tax, the trust is going to jump in right in between. And when it jumps in right in between, it's going to buy it for $5 million. It's going to sell it for $5 million. and therefore the trust has no gain. And you're going to carry back 100% financing, meaning you're receiving a zero down payment. And to the extent you haven't received anything, you're in a deferral state. Okay, because you just became the bank, you became the lender. So this is how it works, right? And step 3 would be to fund, after you fund the DST, is just to invest the DST funds. The funds can be put into real estate syndications, passive or active. You can put it into securities, stocks, bonds, mutual funds, active real estate. You can also purchase it with partners. You can passively invest as well into real estate deals, cryptocurrency, business ventures. Basically, you can do just about any kind of investment. Just can't be like a primary home or use it for personal use. That's just taxable. Now, of course, these trusts are also paying you cash flow. So you can use that, pay your tax on it, do whatever you want with those, but the cash flow. And the key is you can diversify into multiple things, which is really neat. So the next thing is closing step number 4 is you can enjoy your wealth and you can give more. And that's where the transformation really comes from, right? Whether it be giving more of your time, your energy, having more location freedom, financial freedom. This can be, you can be passive or active. You can be an entrepreneurial freedom. You can do all of those things with the Deferred Sales Trust. You just have to figure out which ones you want to do, and we structure the strategize and build the plan and execute that business plan based upon that. As a reminder, these are 10-year notes, and every 10 years you can renew for 10 years. You can also typically earning 5 to 8% net of recurring fees. Fees are about 1.5% to set it up on the gross sales price, and about 1.5 to 2% on a recurring basis on the AUM. You can also cash out and pay taxes whenever you want. And again, you can move funds outside your taxable estate. So that being said, I want to open it up for questions. And I want to tell one legal story here to also give you some confidence as well. And this legal story has to do with a gentleman. So open up for questions in just about 3 minutes until one story, and then be prepared, either type your questions in the chat or be prepared to ask him live, unmute yourself. But this particular story has to do with a gentleman he's a world-class financial planner, advisor. He worked with a guy named Bill Gross. His name is David Young. And David and Bill built PIMCO from 80 billion to 1.2 trillion about 20 years ago. They're world-class at what they do. And as you can imagine, these guys get approached with a lot of people that want them to sell their tax deferral thing, right? Or whatever, right? Access to their clients, they want them to be on. Well, they say no to most things, right? Because most things don't have the track record, they don't have the performance, they don't pass the legal kind of scrutiny of what their people are looking for, right? Or what anyone's looking for. So they do a 2-year due diligence. About 5 years ago, they get approached, and this is David and Bill. They all retire, and about 4 guys retire from PIMCO. David forms a group with 4 other guys, and they do a 2-year due diligence on the structure and the strategy. And they found after their 2 years of due diligence, extensive due diligence with their legal team, that the Deferred Sales Trust, they put their name on it, and they became a part of the DST inner circle. And so they'll manage capital for people. And so I always encourage people to go to Capital Gains Tax Solutions, go to my YouTube channel and watch David tell his entire story, because it's powerful. Because if it's good enough for David Young and his legal team after 2 years of due diligence, exhaustive due diligence, is it good enough for Brett, whoever's listening to this webinar, as well as your CPAs and your legal team, right? So with that being said, I want to open up for questions, and then we'll wrap it up. If there's no questions, that's good too. Maybe I did a really great job. You can also put them in the chat. You can unmute yourself. You can go to capitalgainstaxsolutions.com to learn more. We also have our new book coming out with Kevin Harringer from Shark Tank, which is pretty cool. And we have our master class that happens every Friday at 10 a.m. Pacific Standard Time. Those are some of the next steps you can take as well. But we'd encourage you to subscribe to the YouTube channel. Check us out on Instagram, LinkedIn by searching Brett Swarts or Capital Gains Tax Solutions. If no one in the audience has any.
It looks like you just explained everything way too well for everybody. But I appreciate the presentation. I appreciate everybody attending. You just gave your contact information if something comes up. Please feel free to reach out to Brett. I'm assuming because of the technical issues, maybe if they want to see the visuals on your slides, maybe you'll be able to send them out to them. That's up to you,
Yeah.
of course.
Brett at capitalgainstaxsolutions.com, and you can ask for the slide deck. I'm happy to share that. Brett at capitalgainstaxsolutions.com. And then you can also schedule a consultation if you have a live deal. And it's $1 million net proceeds, $1 million gain to qualify. Just go to capitalgainstaxsolutions.com. And then again, the YouTube channel, you have a podcast. I just encourage you to dive in. Education is key. Study this, study this in detail, and then connect with us early so that we can have time to plan. Because we need to set this up before the closing, right? That's important to understand as well. If you're wanting to do this, it needs to be set up prior to the close of escrow, or if you're in a 1031, you need to make sure you're working with a qualified intermediary, which we have, that will allow this. So you should reach out to me for the 1031 contact, for as well as getting at the ebook and setting everything up if this is something you want to take advantage of. Okay.
All right, perfect. Thank you, Brett, and thank you for everybody who attended today. And I hope you all have a great rest of your day.